All right, let's just jump right into this. Welcome to today's Explainer, where we're going to unpack one of the most fascinating and honestly kind of perplexing financial mysteries happening in the semiconductor space right now. We're looking at Applied Materials, ticker symbol AM8. Now, if you follow the tech sector, you already know these guys are absolute titans. But their recent earnings reaction? Yeah, it's left a lot of people scratching their heads. So let's cut through the noise and figure out exactly what went down.
Because look at this setup. It is a total paradox. On one hand, you have absolute triumph. Applied Materials just dropped a staggering, record-breaking revenue number, $9.12 billion. On paper, that's the exact headline every investor dreams of. But then, almost instantly in response to those all-time high quarterly results, the stock took a nosedive in pre-market trading. It's wild, right? A massive juxtaposition. Incredible results met with just a wall of selling.
So, the big question is, what exactly went wrong here? Is this seemingly irrational market reaction a giant red flag waving in our faces, or is it actually a massive golden buying opportunity just disguised as a sell-off? Well, over the next few minutes, we're going to solve this mystery together. We'll look at the real numbers, decode the market's reaction, weigh the risks, and see what the institutional pros are actually forecasting.
So Section 1, the good news, and those record-breaking numbers.
$9.12 billion in revenue for the quarter. Let's just pause on that. That is not just a good quarter. That is an all-time record high for the company, representing a massive 25% jump year over year. And what's fueling this rocket ship? The AI boom, of course. Applied Materials is absolutely critical right now. They make the equipment that makes the advanced chips for data centers and AI accelerators. Basically, they are selling the picks and shovels for the modern AI gold rush. And the best part? That top-line success flowed right down to the bottom line. It wasn't just revenue that crushed it. Their adjusted earnings per share hit a record $3.50. This didn't just meet Wall Street's expectations, it blew right past them. We're talking incredibly strong demand translating directly into flawless execution and hard profits.
And management didn't just pat themselves on the back and call it a day. They actually raised their full-year growth outlook for their core semiconductor systems business, bumping it up from above 20% to above 30% growth. In the finance world, this is the holy grail, a textbook beat and raise quarter. They beat current estimates and raised future ones. Normally, that kind of news sends a stock absolutely soaring. Which brings us to Section 2, solving the mystery and unpacking the sell-off. The biggest reason for the drop really boils down to a classic Wall Street trap, being priced for perfection. Going into this earnings report, AMAT stock had already surged over 100% in the last year alone, literally doubled. Because of that incredible run-up, investors had already baked basically flawless expectations right into the stock price. And when a stock is priced for perfection, even genuinely great news can disappoint if it isn't literally perfect. It triggers a sell the news event where people just decide, you know what, I'm taking my profits off the table. But let's dig into the specific clues that spooked them. Clue number 1. While management didn't raise that full-year guidance, they held back on giving a specific long-term target for their core semiconductor business. For investors who are trying to model out years of future growth, that lack of clarity was a bit of a buzzkill. It introduced just a tiny sliver of uncertainty, and at these high prices, the market absolutely hates uncertainty. That brings us to clue number 2, which is all about China. In the previous quarter, China made up about 35% of Applied Materials' total revenue. But in Q3, that number dropped pretty meaningfully down to 28%. Why does that matter? Well, it's directly tied to U.S. export restrictions and some pretty intense geopolitical tensions. Investors are looking at that headwind and worrying it might stick around or even get worse over the coming years, which could really cap their international growth.
And here is our final clue, valuation. Even with these knockout numbers, we have to admit this is not a cheap stock. It's trading at a trailing price-to-earnings ratio of around 50 and a forward PE of about 32. That means investors are paying a hefty premium for future growth. Now sure, that's not totally insane compared to some other high-flying tech names right now, but it does mean there is basically zero margin for error. If the company missteps even a little bit, those multiples are going to shrink, and fast.
All right, let's move to Section 3, Wall Street targets and what the pros are saying.
Because despite that short-term pullback we just unpacked, Wall Street's consensus is still incredibly bullish. The overall analyst rating across the board is a strong buy. And get this, the average 12-month price target is sitting at $635. That implies roughly a 19% upside from where the stock is trading right now. So the institutional pros, yeah, they are definitely not panicking. In fact, if you zoom in on the top-tier firms, we're talking Goldman Sachs, Mizuho, and Stifel, they've actually slapped price targets on this thing ranging from $650 all the way up to $700. And their reasoning is super consistent. They all point to the exact same catalyst, the massive long-term AI growth story. They're convinced that the fundamental upgrade cycle for semiconductor equipment is just way too powerful to ignore, regardless of a single one-day sell-off.
Now, if you're more of a short-term trader, you probably want your lines in the sand. Your immediate support is sitting right in that $534 to $539 range. That is a super crucial zone because it's exactly where the 50-day and 100-day moving averages cross paths. If the stock holds above that, the technical bull case is totally intact. But if it breaks below, your next major floor is down around $511. On the flip side, if it shakes this off and starts marching higher, you'll want to watch that key resistance level at $554.94. Busting through that signals we're right back in the broader uptrend.
Finally, Section 4, the verdict, where we weigh the risks versus the rewards. Before you make any moves, you have to acknowledge the real risks here. Number one is geopolitics. Like we just saw, that China revenue exposure is shrinking, and if export controls get any tighter, revenues will absolutely feel the pressure. Risk two is cyclicality. Look, semiconductors are famous for boom and bust cycles. AI is driving a massive upcycle today. But when chip makers eventually cut spending, an equipment supplier like AMAT feels it first. And risk three is valuation. At these multiples, they literally have to execute flawlessly. Any stumble could compress that valuation multiple really fast.
So it all distills down to this one crucial question for you. Does the long-term AI megatrend actually outweigh those short-term risks? Look, Applied Materials delivered objectively incredible, fundamentally strong numbers. The AI demand is highly tangible, and Wall Street clearly sees major upside ahead. But the stock ran up so fast that even a picture-perfect quarter triggered a reality check. For long-term investors, you've got to ask yourself, is this just a healthy pause and a great chance to buy the dip, or is it the start of a broader slowdown? As always, use this explainer as a jumping-off point to do your own research, understand your own risk tolerance, and never base a huge decision on just a single quarter's reaction. Thanks so much for joining me, and keep questioning the numbers.